Welcome back to Griffonomics. It is Tuesday, February 10th, 2026. And look, if you've been watching the ticker tape this morning, you might be scratching your head a little bit.
Just a little bit.
Because for the last, 2 years, the narrative has been pretty consistent. Software is dead, or, at least SaaS as we know it is on life support.
The idea that AI is coming for everyone's job.
Exactly. AI is going to come in, it's going to write all the code, and it's going to replace all the humans who use the software.
That has certainly been the fear, the death of the seat narrative. That's what people have been calling it.
Death of the seat. I like that. But then, this morning happens, we get an earnings report from Datadog ticker DDOG that just, it kind of blows that whole doom and gloom theory right out of the water.
It creates a massive contradiction in the market, doesn't it? I mean, how can both things be true at once?
They can't. And that's what we're here to unpack. We have a massive stack of documents today. The Q4 2025 earnings call, which just wrapped up a few hours ago, the new 2026 growth strategy reports, and a whole slew of analyst notes from JP Morgan, Seeking Alpha, Truist, you name it.
All the heavy hitters.
All of them. And the question I really want to answer today is, I think, pretty simple. Is this company just lucky? Are they just riding some weird temporary wave? Or have they actually figured out how to become the operating system of this new AI world?
That is the right question. Because if you really dig into the numbers, and this isn't luck, this is a fundamental shift in how the digital world is being built.
Okay, a fundamental shift.
And Datadog is positioning itself not as another software tool, but as the utility company. It's the electric meter for the entire AI revolution.
The electric meter. I like that. We're definitely going to get to that analogy. But before we get into, the sci-fi future of AI agents fixing themselves, we have to look at the here and now. Because the numbers that dropped this morning were not small.
No, they were huge.
Okay.
Absolutely massive.
So help me set the scene here. Because to understand why everyone is, freaking out about this report today, we have to remember where we were just a couple of years ago. Let's talk 2023, 2024, the dark ages of cloud software.
The hangover, that's what I call it. You really have to remember, during COVID, companies bought everything. Everything.
If it had a login screen, they bought a subscription.
Exactly, they bought it. Then the economy tightened, rates went up, and suddenly the CFO, the chief financial officer, became the most important and maybe the most feared person in the entire IT department.
The CFO mandate. I remember this so clearly. The memo comes down, cut the bill.
Precisely. It was the era of cloud optimization. That's the polite corporate term for it, right? In reality, it was slash and burn.
It was triage.
It was. Companies were looking at their Amazon AWS bills, their Azure bills, and yes, their Datadog bills and saying, why are we spending $10 million a year on this? Turn it off. Find a cheaper way.
And Datadog got hit hard by that, didn't they? Because their whole model is based on usage.
Exactly. So if your customers use less cloud, you make less money. It's a direct correlation.
So their growth slowed down.
It slowed pretty dramatically. The stock took a beating, and the market basically looked at it and said, well, see, the party's over. Usage-based software is just too volatile, too risky.
Okay, so that's the context, the hangover. Fast forward to this morning, February 10th, 2026. The CEO, Olivier Pomel, gets on the earnings call. And the tone. It wasn't defensive. It wasn't apologetic.
It was the absolute opposite. It was a victory lap. The word of the day, if you read the transcript, is acceleration. The era of optimization is officially dead.
It's over.
It's over. Companies are done just cutting fat. Now they're trying to build muscle again. They're investing.
Let's put a number on that. The top line number. Revenue for the quarter came in at $953 million.
$953 million, just shy of $1 billion in 90 days. It's a staggering figure.
And that's beating Wall Street's estimates by about 35 million. But the percentage is what really caught my eye. 29% year-over-year growth.
And that is the key. That's the inflection point. For a company this size, breaking that 20% barrier again and getting close to 30, that's incredibly difficult. It's a signal.
Was it a signal of?
It signals that the headwinds we just talked about, they haven't just disappeared. They've actually turned into tailwinds.
But why? I mean, is it just that the economy is a little better? Or is there something else happening under the surface? Because I saw a note in the transcripts about vendor consolidation.
Yeah.
And that sounds, it sounds like boring corporate jargon. But you think it's a big deal.
It is the biggest deal. It's the primary driver of this whole acceleration story.
Okay, unpack that for me.
Think about it from the customer's perspective.
No.
Let's say you are the CTO at a Fortune 500 company. Over the last 5, maybe 10 years, Your teams have acquired a dozen different monitoring tools.
Right, the DevOps team bought one thing, the security team bought another.
Exactly. You have Splunk for your security logs. You have maybe New Relic or Dynatrace for your applications. You have Grafana for your dashboards because it's open source and look cheap at first. You have the native tools from AWS and Azure.
It's a Frankenstein monster, a patchwork quilt of software.
It's a complete mess. And it's incredibly expensive, not just in the sticker price of the licenses, but in brain power.
How so?
Your engineers are context switching constantly. They're jumping between 5 different tabs. They can't see the correlation between a security hack they spotted in Splunk and a server that's crashing in AWS because the data is in 2 completely different silos. They don't talk to each other.
So the consolidation trend is basically that same CFO from before saying, okay, I'm sick of paying 10 different invoices. I want to pay one.
Exactly. I want one platform, one bill, one number to call when things go wrong. And Datadog is walking to those meetings and saying, we can be that one.
And it's working.
It's more than working. There's a specific story in the earnings call that really illustrated this. They talked about landing a large customer whale.
A whale, okay.
This is an AI foundation model company. They didn't say the name, of course, but think big. Think of the top players.
So one of the big boys. An OpenAI, an Anthropic, that kind of level.
Right. And this company signed an 8-figure deal in Q4.
Whoa. Hold on. 8 figures. So we're talking $10 million plus.
$10 million plus annualized.
Yeah.
Yes. And the reason they signed it wasn't just because they liked the dashboard's color scheme. It was because they were drowning in complexity.
The Frankenstein monster.
Exactly. The call transcript mentioned they had 5+ different tools, open source stuff, commercial stuff, cloud native stuff. They ripped it all out.
All of it.
Ripped it all out and put everything, I'm talking logs, application traces, infrastructure metrics, even security signals, all of it onto the Datadog platform.
So Datadog truly becomes the single pane of glass.
That's the industry term, yeah. And when you become the single pane of glass for a company that big, a company that is defining the future of technology, you are no longer just a tool.
Your infrastructure.
You are infrastructure. You are as vital as the electricity running the servers. You're the water main.
That makes perfect sense. Because if you rip out Datadog at that point, you're flying completely blind. You have no idea what's broken. You don't know what's secure. You don't know what it costs.
You're basically guessing. And that stickiness, that deep integration is what drives this entire business model. It's incredibly powerful.
Okay, let's unpack that business model a bit more then. Because I think there is a common misconception that Datadog is just that dog logo that shows me if my server is hot. You know,
yeah,
a simple dashboard.
A very expensive dashboard in that view.
Right. But the report today highlights something they call the $1 billion club. And this really puts the scale into perspective.
This part is truly impressive. I mean, you have to understand, in the software world, getting a single product line to $100 million in annual recurring revenue, ARR, that's a huge milestone.
That's a successful company right there.
That's a company that could go public on its own. Getting $1 to $1 billion is, well, it's unicorn territory. It's incredibly rare.
And Datadog has.
How many?
They have 3 separate product lines, all running simultaneously, each doing over $1 billion a year.
That's a company of companies. Okay, let's walk through them because I want to understand what they are actually selling that is worth so much money.
Okay, so the first one is the Anchor, infrastructure monitoring. This is the original product. It's the one you mentioned.
Is the server on?
Pretty much. Is the server on? How busy is it? Is it running out of disk space? That foundational product is now generating over $1.6 billion in ARR.
$1.6 billion just for that. So that's the bread and butter, the entry point for most customers. It is. But then you have the second pillar, log management. This is about collecting all the text data, the diaries, if you will, that your systems spit out every single second.
Error messages, status updates, all that stuff.
All of it. That has officially crossed the $1 billion ARR mark. And the third one, and honestly the most technically impressive pillar, is APM, Application Performance Monitoring.
And that one also crossed $1 billion.
Also crossed $1 billion.
Okay, explain APM to me like I'm 5. How is that different from just watching the server? It sounds similar.
It's a great question. So infrastructure monitoring tells you if the machine is healthy, the car itself. APM tells you if the engine inside the car is healthy. It tells you if the code is healthy.
Oh, okay.
It traces a single request, like when you click Add to Cart on an e-commerce site, all the way through the dozens of microservices, through the database, the payment processor, the inventory system. It finds the needle in the haystack.
So if the Add to Cart button is taking 5 seconds to load instead of half a second, APM tells you exactly which line of code
Yeah.
on which server is causing the traffic jam.
Exactly. And that's a billion-dollar problem for businesses. And that APM business is growing in the mid 30% range.
So it's the fastest growing of the 3 big ones.
By far. And that is incredibly fast for a product that is already making $1 billion. It strongly suggests they are stealing significant market share from competitors like Dynatrace, who often specialize in just that one thing.
It goes right back to that consolidation argument we were just talking about. Why pay Dynatrace and Datadog when Datadog can do it too, and all the data is in one place?
Precisely. But here's the kicker. The most interesting part of the product update for me wasn't even about the big 3. It was the new kid on the block, the 4th pillar.
And that would be security.
Security.
I saw this. They announced that their security products have officially crossed $100 million in ARR.
Which, again, is massive. If this was a standalone startup in Silicon Valley, it would have $1 billion valuation and be prepping for an IPO right now.
And Datadog just grew it inside their existing business.
They did, but let's play devil's advocate here. Security is a very crowded room. You have giants like Palo Alto Networks, you have CrowdStrike, you have Zscaler. Why would anyone trust a monitoring company to secure their bank?
That's the billion-dollar question. And the answer is context. It all comes back to the data.
Explain.
A dedicated security tool, like a firewall, it sees bad traffic, it sees an attack, but it doesn't always know why it's happening or where it's coming from deep inside the code. Datadog already has all the logs. They already have the application traces from APM. They have the map of the entire infrastructure. So they are basically saying, hey, we're already collecting all this data to check for bugs and performance issues. Why don't we just scan it for hackers while we're at it?
Exactly. It's the ultimate logical upsell. It's not a stretch. Do you want fries with that? Except the fries are cloud security that's integrated with everything you already use.
And they were pretty explicit about who they're going after.
Oh, very explicit. The earnings call mentioned displacing legacy SIEM providers. And they are specifically publicly targeting Splunk's installed base.
Oh, the gloves are off.
They are, especially with the Cisco acquisition of Splunk. You know, whenever a big legacy hardware company buys a nimble software tool, innovation usually slows down. Prices go up, customers get nervous.
And Datadog is there to pounce on that uncertainty.
It's the perfect moment to strike. It's a brilliant strategy.
It is smart. But, there's one thing that always stops me when I look at Datadog, and I hear this from engineer friends all the time. It is expensive.
Understatement of the year.
Like, accidentally leave something on and blow your entire quarterly budget in a single weekend. Expensive.
Yeah.
Did they address that? Because if they want to be the utility, like electricity, they can't bankrupt their customers.
They absolutely addressed it. And it's a huge part of their growth story now. They did it with a product called FlexLogs.
FlexLogs.
Yeah.
Okay, it's like a gym routine.
Laughs. It's actually a really clever storage strategy. See, traditionally, log management is so expensive because you have to keep all that data on what's called hot storage.
Meaning fast, expensive hard drives.
Exactly. So you can search it instantly. Because when the server crashes at 3 a.m., you need the answer now, not in 2 hours.
Right. But most logs aren't for emergencies.
That's the key insight. 99% of logs are useless on a day-to-day basis. They are just routine status updates. I'm okay, I'm okay, I'm okay. You only need to keep them for, say, compliance reasons, or just in case you need to investigate something weird that happened 6 months ago.
So what were companies doing? Just deleting them or not sending them to Datadog in the first place because it cost too much?
Exactly, both. They were leaving valuable data on the table because they couldn't afford to store it. So FlexLogs separates the compute from the storage.
What does that mean?
It allows customers to send everything to Datadog, but most of it goes to cheap, slow storage like putting your winter clothes in the attic. It costs pennies on the dollar, but if you ever need it, you can rehydrate it and go get it.
I see. So it brings all those cost-sensitive customers into the fold. The ones who previously said, we can't afford Datadog, now can say, well, we can afford the Flex tier.
And that product alone is nearing $100 million in ARR. It effectively neutralized the single biggest objection to buying Datadog.
Okay, so the platform is huge. They're consolidating the market. They've solved the cost issue. But now we have to get to the elephant in the room, or maybe the robot in the room.
The AI thesis.
This is the part of the deep dive where I really need you to walk me through the logic here. Because the bear case, the negative view, is really simple and honestly pretty compelling. AI, like GitHub Copilot or that agent Devin we're hearing about, is going to write code. That means companies will need fewer human developers. If there are fewer developers, there are fewer seats to sell software to. Salesforce sells seats. Zoom sells seats. Atlassian sells seats. If the humans go away, the revenue goes away. So why is Datadog immune to this?
This is the volume versus seats debate.
Yeah.
And you're right, it is the single most important concept for anyone investing in software for the next decade.
Okay.
Datadog is a hedge against the AI job apocalypse because they don't charge by the human.
They don't care if a human wrote the code or a robot wrote the
Well,
code.
not only do they not care, they actually prefer the robot.
Why? Why on earth would they prefer the robot?
Think about it from a data generation perspective. A human developer is slow. They're methodical, they write some code, they test it, they get a coffee, they go to a meeting, they write a little more code. They are constrained by biology.
And the need to sleep and eat.
Right. An AI agent doesn't sleep, it doesn't drink coffee, it doesn't go to meetings, it can generate code and infrastructure at the speed of light. But here is the critical catch.
There's always a catch.
The code it writes is not perfect. In fact, right now, it creates massive sprawl.
Sprawl. What do you mean by sprawl?
Imagine you tell an AI agent, build me a new social media app. A human might spend a week carefully planning it. The AI might, in 10 minutes, spin up 20 different microservices, create 5 different types of databases, and generate a terabyte of logs just testing thousands of different configurations simultaneously. It creates a digital mess.
That's a great analogy. It's like a toddler with an infinite supply of building blocks.
A toddler with an infinite supply of building blocks and a direct line to your corporate credit card.
That is a terrifying image.
It is, and that's what management calls the paradox of efficiency. AI makes writing code cheaper and faster, so we will have more code, an explosion of code. But more code means more complexity, and more complexity means you need more observability, you need more monitoring.
So the more chaos the AI creates, the more you need Datadog to make sense of that chaos.
Exactly. Management had a great quote on the earnings call. They basically said AI creates a mess that requires picks and shovels to manage. Datadog sells the picks and the shovels.
And their pricing model benefits from this mess.
It's perfectly aligned with it. They charge by the host, by the server, they charge by the gigabyte of logs ingested, they charge by the number of traces. So if an AI agent spins up 1,000 servers for an hour to run a massive test, Datadog gets paid for 1,000 server hours. A human would have used one server for a day.
Okay, that makes total sense theoretically.
Yeah.
But is it actually happening in reality? Do we have proof that AI companies are spending more?
We do. And this was the stat that really dropped jaws on Wall Street this morning. Datadog now serves 14 of the top 20 AI model builders in the world.
Wow, so the people actually building the AI, the smartest and most advanced engineers on the planet, are using Datadog to do it.
Correct. That's a massive vote of confidence. And they also tracked a specific cohort of about 650 AI native customers. These are startups built entirely on AI from day one.
And what did they find?
That cohort is growing significantly faster than their core business. And get this, 19 of them, these are mostly startups, remember, are already spending more than $1 million a year with Datadog.
Wait, hold on. 19 startups are spending $1 million a year just on monitoring.
That just shows you the sheer scale of the data and compute they are generating. These companies are burning through resources like crazy to train and run their models, and Datadog is the tax collector on all of that activity.
So in a way, investing in Datadog is like buying an index fund for AI usage. You don't have to pick which AI company wins the war.
You don't.
You just bet that all of them will be messy and complicated and expensive to run.
Precisely. You're betting on the complexity.
But they aren't just watching the AI, are they? I saw something in the product update section about Bits AI, and this sounded different. It sounded like they're trying to fundamentally change what the product actually does.
This is section 4 of our investigation, and you're absolutely right. This is the pivot to active remediation, and it is a fundamental shift in the company's philosophy.
Okay, what does active remediation mean in plain English?
For the last 10 years, Datadog was all about passive monitoring. The tool watches your server. If the server catches fire, the dashboard turns red and it sends an alert, an email, a text to a human.
Hey, wake up, the website is down, fix the server.
It's the check engine light in your car.
Yeah.
It tells you there's a problem, but you, the human, still have to take it to the mechanic.
Okay.
Now, with Bits AI and what they call the SRE agent, Site Reliability Engineering Agent, they are moving to active remediation.
So, the car fixes itself.
Exactly. Or at least it tries to. Imagine a tiny robotic mechanic hiding under the hood of your car. The engine starts to overheat. Before the check engine light even comes on, the mechanic automatically reroutes the coolant, adjusts the fan speed, and fixes the problem. You just get a notification on your phone later saying, "Hey, I fixed a thermal event for you. You're welcome."
That sounds great for the engineer who gets to sleep through the night. But what does it mean for the business? What's the strategy here?
It means Datadog is declaring war on a whole new sector of the software market. We call it ITSM, IT Service Management.
And that's companies like PagerDuty,
Mm.
ServiceNow.
Exactly. Their whole business model is managing the human workflow of an incident. The ticketing system, the alerting schedules, waking people up in the right order.
But if the Datadog agent just fixes the problem automatically, you don't need a ticket. You don't need to wake anyone up.
Exactly. If the observer becomes the operator, the middleman gets cut out. Datadog isn't just trying to be your dashboard anymore, they're trying to eat the help desk.
That is an incredibly aggressive move. Are people actually using this, or is it just a cool demo video on their website?
It's very real. They said on the call that over 2,000 customers are already using the Bits AI features for investigations. That is a very steep adoption curve for a new product like this.
And there was one other AI product mentioned, LLM Observability. This is for companies building their own chatbots and AI models, right?
Yes, and this addresses a huge fear that every company has right now as they rush into AI.
Which is?
The runaway costs. We've all heard the horror stories, right? An intern hooks up an API to OpenAI, accidentally creates an infinite loop in their code, and over the weekend they rack up a $50,000 bill.
The nightmare scenario for any CTO.
It is. So Datadog's LLM observability product sits in the middle and tracks that. It answers the critical business questions. How much is this specific user's query costing me? Is my model hallucinating and giving bad answers? Why is it being so slow for my customers in Europe?
So it's about cost control and quality control for your own AI.
Exactly. And the usage of the underlying protocol for that tool grew. What was the number?
I have it here. It grew 11-fold in Q4 alone.
11-fold, not 11%, 11 times over.
That's exponential growth.
It is. And it confirms the thesis that enterprises are moving from just playing with AI in a sandbox to putting it into real production applications where real money is at stake.
Okay, this is all incredibly compelling. The strategy is sound, the products are growing like crazy, the AI story is convincing. But let's look at the bank account. Let's do the financials, because none of this matters if they are running out of money to fund it all.
This brings us to the financial realities of Q4. And honestly, a financial fortress is the only way I can describe it. The balance sheet is pristine.
Give me the high-level numbers.
Cash equivalents, and marketable securities on hand, $4.47 billion.
Okay. And debt.
Total debt, about $983 million.
So they have nearly $3.5 billion in net cash just sitting there.
Just sitting there, earning interest. In a high interest rate world like we're in now, that cash pile alone is probably generating over $150 million a year in pure risk-free profit just for existing.
You give them massive optionality, as they say. They can buy a competitor. They can hire the best engineers away from anyone. They can weather any recession that comes their way.
And they are very profitable on an operating basis, too. We always look at the rule of 40. That's the golden metric for software investors.
Remind the listener what that is.
You take the company's revenue growth rate and you add its profit margin. If that number is over 40, it's considered an elite, healthy, efficient company.
And Datadog is where on that scale?
29% growth plus about a 24% operating margin. So that's a 53. That is elite territory. There are very few companies at the scale putting up numbers like that.
But for me, the number that I think is the real crystal ball here, the one that tells us about the future, not the past, is RPO.
Remaining performance obligations, yes.
Break that down for the listener who isn't a CPA. What exactly is RPO, and why does it matter so much?
Think of it as the company's backlog. It's the total value of all the contracts that customers have signed, but that Datadog hasn't billed for or recognized as revenue yet.
Okay.
So if I'm a customer and I sign a 3-year deal with you for $30 million, but I agree to pay you $10 million a year, in this current quarter, you recognize $10 million in revenue, but you have $30 million in RPO.
So it's locked in future money. It's guaranteed revenue that's coming down the pipe.
It's the best indicator of long-term customer commitment that exists. And this number,
Yep.
It didn't just grow, it surged. It jumped 52% year over year to $3.46 billion.
Wait, hold on. 52%. Their revenue only grew 29%. How is the backlog growing almost twice as fast as their current sales?
That is the single most bullish signal in the entire report. That's what has analysts rewriting their models this morning. It means the duration of the contracts they're signing is getting longer and larger.
So customers aren't just renewing for another year.
No, they are signing massive multi-year deals. They are locking in Datadog for 2026, 2027, 2028. This isn't a trial run anymore.
That goes right back to the consolidation thing. If I'm a big bank and I'm ripping out Splunk to move everything to Datadog, I'm not doing that for a one-year experiment. I'm getting married to the platform.
Exactly. It provides incredible visibility into future growth. When the CEO gets on the call and says, "We expect to grow strongly next year," he's not just guessing. He's looking at a spreadsheet with $3.5 billion in signed contracts already on the books.
Okay, this sounds, honestly, it sounds almost too good. And that always makes me nervous.
Yeah.
We are investigators here. We're not cheerleaders. We have to look at the risks. What could derail this train?
There are absolutely real risks, and we have to start by talking about that whale again.
The 8-figure AI customer.
Yes, we celebrated them as a huge win, and they are, but they are also a huge risk. The term is customer concentration. A significant chunk of that 52% RPO surge is tied to that one massive AI customer.
That is a lot of eggs in one basket. What happens if that AI company fails? We all know the AI market is a bit of a bubble right now. What if they go bust next year?
If they go bust, or if they get acquired by, say, Google or Microsoft, who then force them to use their own internal monitoring tools, that creates a massive crater in Datadog's future financials.
So Datadog is, in a way, leveraged to the success of its biggest customers. If the AI startup boom turns into a crash, Datadog feels the pain directly.
Exactly. They are selling the pickaxes to the gold miners.
Yeah.
If the gold rush ends and the mines turn out to be empty, the miners stop buying pickaxes. It's a real risk.
Okay, what else? What about the stock price itself? Is it cheap?
Oh, definitely not. Datadog has never been a cheap stock. It's currently trading at roughly 10.4 times its expected revenue for next year. That is a premium valuation. You are paying a Mercedes price for a Mercedes engine.
So if they miss an earnings report, if that growth slows down from 29% to, say, 24% one quarter,
the stock could easily drop 20% in a single day. That is the danger of high expectations. When you're priced for perfection, you have to be perfect. Every single time.
And then there's the big one, the existential risk, the agentic AI threat we touched on earlier. You said Datadog wins because AI today creates messy code.
Right, in the medium term.
But technology improves. That's what it does. What if, in 5 years or 10 years, the AI agents get really good? What if they write perfect, self-healing code that never crashes and never has security holes? If the code is perfect, do you need a monitor?
That is the ultimate long-term bear case, the self-driving cloud. If the car never crashes and automatically maintains itself, you don't need a dashboard or a mechanic anymore.
Right. So what's the counter-argument to that?
My counter to that, and I think the sources we've read would agree, is that we are probably decades away from that, if it's even possible at all. Entropy is a fundamental law of the universe.
Things tend toward chaos.
Exactly.
Yeah.
Systems naturally move toward disorder, not order. And the more complex we make these AI systems, the more interconnected they are, the more surface area there is for weird, unpredictable, emergent errors to occur.
So you're basically betting on chaos.
I'm betting on entropy. And I'm betting that as long as humans are asking machines to do incredibly complex things, things will break in new and interesting ways. And as long as things break, Datadog has a business.
Fair enough. So let's bring this all home. Let's get to a verdict. We've looked at the strategic pivot, the billion-dollar products, the AI thesis, the fortress financials, and the very real risks. How do we synthesize this? How do the sources write this?
Based on everything we've analyzed today, the overwhelming consensus from the analyst community is a strong buy.
Okay. Summarize the case for me. Give me the 3 core pillars of the bull thesis.
Number 1, utility status. It has successfully become the electricity meter for the cloud. You cannot run a modern, complex digital company at scale without it. It's no longer optional.
Number 2.
The protected portfolio. It is one of the best hedges against AI disruption in the entire market. If AI replaces humans and creates a data explosion, Datadog wins on volume. If that takes longer than we think and humans keep building, Datadog wins on seats and enterprise adoption. It works in both scenarios.
And number 3?
The consolidation winner. In a fragmented, confusing market, the platform that does everything, infrastructure, logs, APM, security, and now remediation, that's the platform that wins the CFO's budget.
I like that phrase we came up with during our prep for this deep dive. Risk defined, portfolio protected.
I think that sums it up perfectly. You know the risks, the valuation is high, there's some customer concentration, but you are buying what is arguably the best house in the best neighborhood in the entire software city.
Before we sign off, I want to leave you, the listener, with one final thought. A bit of a provocation to mull over. We talked about active remediation. We talked about the software starting to fix itself.
Yes, the observer becoming the operator.
Exactly. So if Datadog continues down this path, moving from telling you what's broken to autonomously fixing what's broken, at what point does the monitoring tool start running the company?
That is the ultimate question, isn't it? When does the observer become the operator?
Right. Think about it. If Datadog is the one securing the cloud, managing the cost overruns, and automatically fixing the code, eventually Datadog isn't just a tool your engineers use, it's the CIO. It's the automated IT department.
A fully autonomous cloud, managed by the dog. It's a fascinating and maybe slightly scary future to think about.
It is, and we'll be watching very closely to see if they can get there. Thanks for listening to this deep dive on Griffonomics. We hope this cleared up some of the noise around the earnings report today.
And as always, check the show notes for the links to all the source documents. There is some really great reading in there if you want to geek out on the RPO numbers like we did.
We'll see you next time.